Right, so you wanted to go over this Morgan Stanley report on India.
Yeah,
It's their equity strategy for 2025, dated January 3rd.
right.
And I think specifically you were interested in if India is the market to beat this year,
Yeah,
what the growth potential looks like, and of course the risks that we need to be watching out for.
exactly. And I think right off the bat, this report is incredibly bullish on India.
Oh.
They're predicting it to be a top performer amongst emerging markets. And a key reason for that is they're calling it a Goldilocks scenario developing in India.
Okay, Goldilocks. That's always a good sign in economics, right?
Great.
Tell me more about why they're using that term.
Well, it all comes down to a confluence of factors that seem to be aligning in India's favor right now.
Okay.
The first being remarkable macro stability. And they point to favorable terms of trade and a flexible approach to inflation management.
Okay, so a stable economic foundation,
Yeah,
but we need more than just stability for a market to take off.
absolutely. And that's where their second pillar comes in. Earnings growth, they're projecting 18 to 20% annual growth over the next 4 to 5 years.
Wow, now those are the kind of numbers that get investors excited. What's fueling that kind of growth projection?
Well, a perfect storm of positive forces.
Okay.
A new wave of private investment in infrastructure companies are leveraging debt for expansion, and we're seeing a fundamental shift in consumer spending towards non-essential goods and services.
So it's not just a case of catching up, it's India leveling up in terms of economic sophistication.
Precisely. And what makes this even more compelling is that this growth isn't solely reliant on foreign investment.
Right.
India has a robust and consistent flow of domestic capital into its market.
Which acts as a kind of ballast, making it less vulnerable to global market swings.
Exactly. And that resilience is reflected in India's low beta of 0.4 to emerging markets. And it helps explain why India's market might seem expensive at first glance,
Right.
but actually holds up quite well during turbulence.
Interesting. It seems like India is doing a lot of things right. But let's get specific. What are the catalysts that are driving this positive outlook, according to the report?
Well, they break it down into a few key areas on the policy and reform front. The recent Maharashtra elections have eased market concerns about the government's ability to implement crucial reforms, and the report highlights their commitment to achieving a zero primary deficit as a sign of fiscal discipline.
Which basically means that government revenues cover all expenses except for interest payments, right?
That's right.
Okay.
And this commitment to fiscal responsibility is expected to be a key focus in the upcoming February budget.
So a government that's focused on both growth and stability, what other policy areas do they highlight?
Well, they touch on a number of them, including infrastructure spending, GST rate, restructuring direct tax reforms,
Okay.
free trade agreements, and of course, the energy transition.
It sounds like they've got a lot on their plate. It seems like they're creating a pretty attractive environment for businesses.
That's the impression I get as well. But it's not just about the right policies companies need to deliver on the earnings front as well.
Right, and that's where things get particularly interesting. The report's earnings estimates for Indian companies are actually higher than the general consensus.
Uh-huh.
So are they saying that there's even more upside potential than people realize?
That's the suggestion, but of course, no market exists in a vacuum. So what about the global context?
Right.
How much does that play into their outlook for India?
That's a great question. While India's correlation with global markets has decreased, it's not completely immune to what's happening in the rest of the world.
You're absolutely right. The report acknowledges that global factors can still impact Indian earnings and stock behavior, things like policy actions in China and the U.S. outcomes of ongoing conflicts. All of these can play a role.
Makes sense. What about interest rates? Any predictions on that front?
Well, they predict a shallow easing cycle with a total reduction of 50 basis points in interest rates.
Okay.
So we're talking 2 consecutive rate cuts of 25 basis points, each starting in February.
So a gradual approach. What else should we know about the interest rate landscape?
Well, they mentioned the RBI's commitment to stable liquidity, and there's a hint that we might see some easing of regulatory tightening as well.
So it's not just about the rate cuts themselves. It's about the overall approach to managing liquidity. What else caught your eye in this section of the report?
Well, they highlight what they call the issuance boom, which refers to the increasing number of companies going public.
Right.
Issuances are currently at about 1.3% of GDP, up from previous lows, but still well below the peak of 3.5% we saw a few years back.
So a notable increase, but not necessarily a cause for concern.
Right. And what's really important is that strong demand from retail investors is currently outpacing the supply of new stock.
So it's like a rising tide lifting all boats. All right, let's get to the heart of the matter. What are Morgan Stanley's specific predictions for the BSE Sensex?
Well, they lay out 3 scenarios. a base case, a bull case, and a bear case, each with their own set of assumptions.
Okay, let's start with the base case. What's their prediction, and what are the key factors driving it?
In the base case, they predict an 18% rise in the BSE Sensex by December 2025.
Okay.
Crucially, this hinges on India maintaining its macro stability through fiscal consolidation, rising private investment, and a positive real rate gap.
Okay.
They're assuming robust domestic growth, no U.S. recession-stable oil prices, a modest reduction in interest rates,
Well,
and a favorable liquidity environment. Steady stock issuances with retail demand remaining strong. And a key driver of this, according to the report, is their projection of a 17.3% annual earnings growth for Sensex companies through 2027. That's actually 15% higher than the general consensus.
so even their base case is quite optimistic. Now, I'm really curious about their bull case.
Yeah.
What has to go right for India to hit those numbers?
Well, in their bull case, they anticipate a 34% surge in the BSE Sensex, reaching a whopping 105,000 by December 2025.
Wow, that's a significant jump. What needs to happen for that to materialize?
A few key things. They assume oil prices stay below US $70 per barrel, leading to lower inflation and more aggressive rate cuts. They factor in continued improvement in India's energy balance and successful government interventions to stabilize food prices.
So it's a combination of favorable external factors and effective internal policies.
Exactly. On the global front, they assume continued U.S. economic growth, which would attract more foreign investment into India.
Okay.
And interestingly, they even consider the possibility of INR balances currently stuck in Russia returning to India if the Ukraine conflict resolves.
So geopolitical events could play a surprisingly positive role.
That's right. And lastly, they assume the government will exceed expectations on reforms, specifically GST rate cuts and progress on farm laws.
Okay.
Under this bull case, we're looking at a projected annual earnings growth of 20% for Sensex companies.
Okay. That's a pretty optimistic scenario, but it doesn't sound completely outlandish. Now, for the reality check, let's talk about the bear case. What could derail this India growth story?
Their bear case paints a less rosy picture, forecasting a 20% drop in the BSE Sensex to 70,000 by December 2025.
Okay.
The main culprit here is a potential spike in oil prices above US $110 per barrel, forcing the RBI to hike interest rates.
So a classic case of inflation raining on the parade.
Pretty much coupled with a significant slowdown in global economic growth, potentially even a U.S. recession, that's what drives their bear case. In this scenario, earnings growth for Sensex companies slows to 15% annually, and we see lower stock valuations due to less favorable macroeconomic conditions.
So even in the bear case, they're not predicting a complete collapse, just a correction. But the report doesn't stop at market predictions, right? What's their advice for investors navigating this landscape?
That's where their recommendations get really interesting. Instead of advocating for broad market plays, they suggest a more strategic approach, focusing on specific companies and sectors poised to benefit most from India's unique circumstances.
So stock picking over index funds, what are they recommending investors look at?
They have a clear preference for cyclicals over defensives, arguing that cyclical companies are better positioned for growth in India's current economic environment.
Okay.
They also recommend small and mid-cap companies over large-cap companies.
Interesting. So they're betting on the more dynamic segments of the market. What sectors specifically are they overweighting?
They're bullish on four sectors, in particular financials, consumer discretionary, industrials, and technology.
Okay, let's unpack why they like each of those, starting with financials. What's driving their optimism there?
Well, they see a lot of positives in this sector. Peaking short-term interest rates, increased credit growth, and low loan default rates all favor financial companies, especially non-bank lenders.
So it's a good time to be in the lending business in India.
According to the report, yes. Moving on to consumer discretionary, they expect a resurgence in rural demand to support overall spending growth. However, they do acknowledge the potential risk of raw material cost inflation impacting this sector.
So consumer spending is on the rise, but rising costs could eat into those gains. What about industrials? Why do they like that sector?
The report points to substantial government spending on infrastructure, along with early signs of increasing private investment in the sector.
So the infrastructure boom continues.
Yeah.
And lastly, technology, what's their rationale there?
With technology, they're taking what they call a barbell approach, balancing risk and reward.
Okay.
They acknowledge that the Indian technology sector is less reliant on domestic growth, making it potentially more resilient to global uncertainty,
Uh-huh.
but it's also more vulnerable to a U.S. recession.
A classic case of hedging your bets.
Okay.
Okay, those are the sectors they like. What about the ones they recommend avoiding or reducing exposure to?
They advise investors to be cautious with communication services, utilities, consumer staples, energy, healthcare, and materials.
Wow, that's quite a list. Why are they underweighting each of those?
Well, with communication services, they just see better opportunities elsewhere. Utilities get an underweight because they're not very sensitive to economic cycles with consumer staples. They argue that while fundamentals might improve, stocks in this sector remain overvalued. Remember their preference for cyclical sectors.
Right, so doubling down on discretionary spending. What about energy?
They prefer domestic cyclical plays over global ones, and energy falls into the latter category for healthcare. It's simply a case of them avoiding defensive sectors due to limited growth potential. And finally, with materials, while they prefer domestic material companies, they feel they already have exposure to the sector through their industrials overweight.
So being strategic about where they get their exposure.
I'd say
Also understand the report includes a focus list of 10 recommended stocks across various sectors. What are some of the standouts on that list?
Well, they highlight a few companies with strong performance. Brainbees Solutions, a consumer discretionary company with a solid market cap.
Okay.
Trent, another consumer discretionary company boasting a remarkable 136% growth in the last 12 months. Reliance Industries, a major player in the energy sector, and Hindustan Aeronautics, an industrial company that's seen a robust 49.4% growth in the last year.
That's a pretty impressive group of companies. This has been a fascinating dive into Morgan Stanley's outlook for India. What's your key takeaway from all of this?
What I find so fascinating is that while the report is undeniably bullish on India's prospects, they don't shy away from acknowledging potential risks. They emphasize a strategic and selective investment approach favoring specific sectors and companies over broad market plays.
So it's about being smart, not just blindly betting on India's rise.
Exactly.
I like it. So let's leave our listener with a thought-provoking question. What specific global factors beyond those mentioned in the report could significantly impact the Indian equity market in 2025 and beyond?
That's a great question to ponder. It's a complex equation, isn't it? We've talked about global factors, but even within India's own borders, there are trends that could either accelerate or hinder this growth trajectory.
That's what makes this so interesting. So much is happening domestically in India. What internal dynamics did the report focus on?
Well, one of the most fascinating trends is the shift in household savings. We're seeing a notable increase in allocation towards equities.
So instead of traditional investments like gold or fixed deposits, people are putting more money into the stock market.
Precisely, for a long time, Indian households have primarily channeled savings into physical assets. Gold especially has a cultural significance, but with increasing financial literacy and awareness of market-linked investments, people are becoming more comfortable with equities.
And as the market has performed well in recent years, it's attracting more attention and investment. It's a bit of a snowball effect, isn't it?
Exactly. This increased participation from retail investors is actually a big part of what's driving the current market momentum. It's not just big institutions or foreign investors, it's everyday people putting their savings into the market.
Which is interesting because it creates a base of investors who are less likely to pull out at the first sign of trouble.
Right. That's the theory. This influx of domestic capital acts as a stabilizing force, making the market less susceptible to sudden outflows from foreign investors.
But are there any downsides to this trend?
Well, there's always the risk of irrational exuberance.
Right.
When a market heats up, it's easy to get caught up in the hype.
Especially for newer investors who may not have experienced a market downturn before.
Right. There's a risk of impulsive decisions, investing in things they don't fully understand, and potentially panic selling if the market corrects. So while this surge in domestic investment is a net positive, it's important to be aware of the potential pitfalls.
It always comes back to balancing risk and reward. So we've talked about this shift in savings, but what other internal dynamics caught your attention in the report?
Well, I delve into the debt situation in India, specifically corporate debt. The ratio of corporate debt to GDP has been steadily rising.
Is that a cause for concern? Debt can fuel growth, but too much debt can lead to problems.
It's a double-edged sword. Increased borrowing can be a sign of business confidence. Companies are taking on debt to invest in growth, which can ultimately benefit the economy. But if growth slows down or interest rates spike, those high debt levels could become a problem.
Leading to potential defaults and instability.
Exactly. The report points out that India has experienced what they call balance sheet recessions in the past, where companies were burdened by too much debt and had to focus on deleveraging instead of investing in growth.
So it's a delicate balancing act. What's their take on the current level of corporate debt in India? Are they sounding any alarm bells?
They don't seem overly alarmed, but they do emphasize the need for careful monitoring. They're watching for any signs of unsustainable borrowing.
It's all about finding that sweet spot between borrowing for growth and managing debt responsibly.
Couldn't have put it better myself. Now, another interesting point they raise is the role of government spending. India sees strong growth in government expenditure driven by investments in infrastructure, social programs, and defense.
Government spending can be a powerful tool to stimulate the economy, but it also comes with risks.
You're thinking about the fiscal deficit.
Exactly. If spending keeps outpacing revenues, that deficit widens, and that can have a ripple effect on the entire economy.
Right. A large fiscal deficit can lead to higher interest rates, crowd out private investment, and in a worst-case scenario, even trigger a debt crisis. The report does emphasize that fiscal consolidation should be a priority for the government.
So spending wisely and strategically is key.
Absolutely. And they also link government spending to another important factor. Inflation increased government spending can fuel demand pull inflation.
Which basically means that too much money is chasing too few goods, leading to price increases.
Yeah.
And India has been dealing with elevated inflation, right?
That's right. And the report suggests that government spending might be contributing to the problem. So the government is in a bit of a bind. They need to spend to stimulate growth, but they also need to keep inflation under control.
It's like walking a tightrope. Now, shifting gears a bit, the report also examines India's external balance sheet. What's their assessment there?
They paint a generally positive picture, highlighting India's comfortable level of foreign exchange reserves. They also point to a declining current account deficit.
So they have a cushion against external shocks, and their trade balance is improving.
That's the gist of it. But they do caution that India's external balance sheet is still vulnerable to global factors, especially fluctuations in oil prices.
Oil prices, that seems to be a recurring theme.
It is. India is a major oil importer. So when prices rise, it puts pressure on their foreign exchange reserves and widens the current account deficit.
So even with a healthy external balance sheet, they're not completely insulated from global events.
Exactly. This underscores the need for India to diversify its economy and reduce its reliance on oil imports.
Speaking of diversification, the report also touches on the performance of multinational corporations, or MNCs, operating in India. What's the story there?
Well, the report indicates that MNCs have become increasingly bullish on India, attracted by a large domestic market skilled workforce and a relatively favorable regulatory environment.
So it's a combination of market opportunity and ease of doing business.
Precisely, they even mention an MNC sentiment index, which tracks their sentiment towards investing in India, and it's been steadily rising.
That's a good sign. What are the implications of this increased MNC investment?
Well, it can definitely boost economic growth. MNCs bring capital, technology, and expertise, which can create jobs and increase productivity. But some critics argue that MNCs can sometimes stifle local innovation and crowd out domestic companies.
So it's about finding the right balance, ensuring that MNC investment complements rather than replaces domestic activity?
Exactly. The report emphasizes the need for a level playing field where both MNCs and domestic companies can thrive. Now, another factor they look at is liquidity in the Indian equity market.
Liquidity is crucial for any market. What's their assessment?
They suggest the market is generally quite liquid, especially for large-cap stocks, which is good news for investors because it means they can easily enter and exit positions, but liquidity can vary for smaller companies.
So investors need to be mindful of that, especially if they're venturing into small cap or mid cap stocks.
Right. They also link liquidity to the broader concept of financial conditions, which refers to the ease of accessing credit and funding in the economy.
So are they saying that financial conditions in India are favorable right now?
They've been supportive of growth in recent years, but they do see signs of potential tightening. Interest rates are rising, and credit growth has been slowing down, particularly in certain sectors perceived as risky.
So the easy money days might be coming to an end.
Yeah.
What about capital raising through equity and debt issuances? What are they seeing on that front?
Well, both equity and debt issuances have been trending upwards, driven by the need to finance growth and by favorable market conditions that make it easier to raise capital.
So companies are confident and taking advantage of these favorable conditions.
Yes, but excessive reliance on these issuances can become problematic. If companies are constantly issuing new shares, it can dilute the value of existing shares.
Right, you don't want to slice the pie too thin.
Exactly. And over-reliance on debt can increase financial risk and make companies more vulnerable to economic shocks. Investors need to pay close attention to a company's capital structure.
Okay, so we've covered a lot of ground here,
Yeah.
from broad economic trends to corporate finance. Now, I'm curious to hear what the report has to say about the individual sectors that make up this market. Let's start with a closer look at financials.
Financials is a vast sector encompassing banks, insurance companies, asset management companies, and a whole range of other financial institutions. And the report is quite bullish on this sector in India.
Why is that? What
Yeah.
are the key factors driving their optimism?
Well, they point to two major drivers. First, the growth of the Indian middle class as more people enter the middle class. They demand more financial services from banking and insurance to investment products.
A classic case of a rising tide lifting all boats. What's the second driver?
The government's push for financial inclusion, they're trying to bring more people into the formal financial system.
So expanding access to banking for those who have been traditionally excluded.
That's right. This is a huge long-term growth driver for the sector.
Okay, so a growing middle class and greater financial inclusion are fueling growth in financials. But are there any specific trends within the sector that stand out?
Well, they highlight the rapid growth of non-bank financial companies, or NBFCs.
NBFCs, remind me what those are.
They're financial institutions that provide services similar to banks, but they don't have a full banking license. They're often more specialized, more nimble, and more innovative than traditional banks.
So they're able to cater to specific niches that banks might overlook.
Exactly. They're filling a gap in the market, and the report suggests that NBFCs are likely to continue growing rapidly. They also see a lot of potential in the insurance sector.
Insurance is usually seen as a safe and steady sector. What's driving their bullishness on insurance?
The key factor is that the insurance penetration rate in India is still quite low compared to developed countries.
So there's a lot of room for growth.
There is, as incomes rise and awareness of insurance products increases, the insurance sector is poised for significant expansion. Within the insurance sector, they particularly highlight the potential of health insurance.
That makes sense. Rising healthcare costs are a global concern, and India is no exception.
Right. The health insurance market in India is still in its early stages. Increasing incidence of lifestyle diseases, coupled with the rising cost of private healthcare, is creating a perfect storm for health insurance.
Okay, so financials are looking good, especially MBFCs and health insurance. What's next on their list of promising sectors?
Let's talk about consumer discretionary, which includes all those non-essential goods and services that people buy when they have more money to spend.
So things like cars, electronics, travel, entertainment.
Exactly. And the report is quite bullish on this sector, primarily driven by the rising disposable incomes of Indian consumers.
It's a basic economic principle. More money means more spending. What's interesting is that they seem to be betting on the increasing sophistication of the Indian consumer.
Yes, they particularly highlight the role of younger consumers who are more brand conscious and eager to spend on experiences. They also point to the rapid growth of e-commerce as a major catalyst.
The e-commerce boom has been a game changer globally, hasn't it?
Absolutely. It's made it easier for consumers to access a wider variety of products and services, often at lower prices. This has driven growth in categories like electronics apparel and home furnishings.
So it's a combination of rising incomes, evolving consumer preferences, and the convenience of online shopping that's fueling this sector.
That's right. But they do highlight a couple of potential challenges. One is the risk of rising inflation eroding purchasing power. The other is increasing competition in the e-commerce space, which could squeeze margins.
So there are always risks to consider. Now, within consumer discretionary, are there any subsectors that they're particularly excited about?
They highlight two in particular: autos and organized retail. In autos, they point to the fact that car ownership in India is still relatively low, so there's a lot of pent-up demand.
As incomes rise, more people will be able to afford cars. It's a classic aspirational purchase.
Right. They also see a growing preference for SUVs and luxury cars, indicating a shift towards lifestyle-oriented purchases.
So it's not just about basic transportation anymore. It's about making a statement.
Exactly.
Yeah.
Now, with organized retail, they're referring to modern retail formats like supermarkets, department stores, and malls, as opposed to traditional mom-and-pop stores.
So it's about the shift from smaller independent stores to larger, more organized retail chains.
Precisely. And this trend is gaining momentum driven by changing consumer preferences, rising incomes, and the growth of e-commerce. Consumers are looking for a more modern shopping experience with a wider selection of products in a more convenient environment.
Okay, so it's a bet on the evolution of the Indian retail landscape.
Right. They believe that organized retail will continue to gain market share. Now let's touch upon the consumer staples sector.
Consumer staples. Those are the essential goods that people buy regardless of their income, like food, beverages, household products.
Exactly. And in India, this sector is marked by increasing penetration of packaged foods and beverages.
Makes sense with urbanization and busier lifestyles. Convenience becomes a key factor.
They also point to the growing demand for premium and healthy food products. Consumers are becoming more health conscious and are willing to pay more for quality.
So it's not just about filling your stomach anymore, it's about making healthy choices.
Right. They predict steady growth in this sector, but nothing spectacular. Now let's move on to industrials.
Industrials. That sounds like a very broad category.
It covers a range of industries involved in producing goods used in other industries, everything from heavy machinery to construction materials. One major trend they highlight is the government's focus on infrastructure development.
India is investing heavily in roads, railways, airports,
Yeah.
ports.
It's a massive undertaking, and it's creating a huge opportunity for companies involved in construction, engineering, and materials.
So it's a bet on India's continued infrastructure build-out.
Exactly. They also point to the increasing adoption of automation and robotics in manufacturing as a key trend.
Which makes sense in a world where efficiency is paramount.
Right. Automation is helping companies improve efficiency, reduce costs, and become more competitive. They see strong growth potential in industrials driven by these trends.
Okay, industrials are on their radar. What about technology? It's hard to talk about emerging markets without discussing the tech sector.
Technology is a major force in India, accounting for a significant chunk of their GDP and exports.
So it's not just about consuming technology, it's about creating and exporting it.
Absolutely. They highlight the rapid growth of the IT services industry. India has become a global hub for IT outsourcing.
They've really positioned themselves as a brain power powerhouse.
That's a great way to put it. They also point to the rise of startups and digital innovation as a major driver. India has seen a surge in tech startups in recent years, focusing on areas like e-commerce, fintech, edtech, and health tech.
It sounds like a very dynamic and entrepreneurial landscape.
It is. They believe that the Indian technology sector has the potential to grow rapidly, but they also acknowledge the risks inherent in such a dynamic sector.
The risk of disruption, the volatility, it's a sector that requires careful analysis and a long-term perspective.
Right now, shifting gears to a sector that's often overlooked but essential: utilities.
Utilities, we take them for granted, but they're the backbone of a functioning economy. What's happening in that sector in India?
Well, the utility sector is undergoing a major transformation driven by the government's push for renewable energy and a focus on energy efficiency.
So it's a two-pronged approach.
Exactly. India has set ambitious targets for increasing renewable energy and for improving energy efficiency, both in homes and businesses. They see steady growth in this sector, but don't expect it to be a high-return area.
So it's a steady Eddie, not a rock star. Now, what about materials? What's their take on that sector?
Materials are, of course, the building blocks of any economy in India. The demand for raw materials is being driven by rapid industrialization and urbanization. They also point to the government's Make in India initiative, which is focused on boosting domestic manufacturing.
Which in turn increases demand for materials.
Right. They anticipate cyclical growth in this sector, meaning periods of expansion and contraction depending on the economic cycle. Within materials, they're particularly interested in the metals and mining sector and chemicals.
India has a rich endowment of mineral resources, so that makes sense.
Yes, and they see growing demand for metals like steel, aluminum, and copper. In chemicals, they're particularly bullish on specialty chemicals.
So bet on India's manufacturing sector becoming more sophisticated.
Exactly. But they also caution about the volatility of commodity prices and the environmental impact of mining and other extractive industries.
Right. It's not just about growth. It's about sustainable growth.
Now let's move on to healthcare.
Healthcare is always in demand, regardless of the economic climate. What are they seeing in India's healthcare sector?
Well, they highlight the rising incidence of chronic diseases and the increasing affordability of healthcare as major growth drivers.
So demographics and government initiatives are playing a role.
Absolutely. They believe that the Indian healthcare sector is poised for steady growth, but it also faces challenges like a shortage of qualified healthcare professionals and the high cost of care in the private sector.
It's a sector with both potential and obstacles. Within healthcare, are there any subsectors that stand out?
They highlight pharmaceuticals and healthcare IT. India is a major producer of generic drugs, and the demand for affordable medicine is expected to stay strong.
So India is becoming the pharmacy of the world.
You could say that. Now with healthcare IT, they see enormous potential as India's healthcare system modernizes.
So it's a bet on the convergence of healthcare and technology.
Exactly. Now let's move on to energy.
Energy is the lifeblood of any economy. What's happening in India's energy sector?
Well, the sector is undergoing a major transformation fueled by growing energy demand and the government's push towards cleaner energy sources.
So it's a story of increasing demand coupled with a shift towards renewables.
Exactly. They predict mixed results for investors in this sector. There's growth potential, but challenges like regulatory uncertainty and volatile oil prices remain. Within energy, they're particularly interested in renewable energy and energy efficiency.
It sounds like they're betting on a cleaner, more efficient energy future for India. What about the communication services sector? What are they seeing there?
Well, this sector is all about the transmission of information from telecom and media to entertainment, and in India, it's marked by the rapid growth of mobile and internet usage.
India has really embraced the digital revolution, hasn't it?
They have. It's driving growth in areas like mobile data services, online advertising, and digital content. The report also notes the ongoing consolidation in the telecom industry, with a few large players now dominating the market.
So it's a sector that's undergoing a major transformation with both opportunities and risks.
Exactly. They predict steady growth, but it's a competitive landscape that's constantly evolving.
Well, we've covered a lot of ground in this deep dive. From macroeconomics to corporate finance to specific sectors, this Morgan Stanley report has given us a comprehensive view of India's equity market.
It's been fascinating to unpack all of this, hasn't it?
Absolutely. In our next episode, we'll continue this exploration by looking at the companies that are catching Morgan Stanley's attention.
It certainly has. India's market is so dynamic and there's just so much going on.
Exactly. So let's zoom in now and talk about specific companies. What I'm really curious about is their focus list, the 10 stocks they specifically recommend. What stands out to you about those picks?
Well, it's an interesting mix. You can really see their sector preferences reflected in these choices.
Okay.
For example, in the financial sector, they've included HDFC Bank.
HDFC, that's one of the biggest private sector banks in India, right?
That's right. They're a major player in the mortgage market, and they've been consistently profitable. Morgan Stanley seems to be betting on their continued dominance.
It's a solid choice.
Yeah.
A blue chip stock in a sector they're bullish on. Who else is on their list?
In the consumer discretionary space, they've picked Avenue Supermarts,
Okay.
which operates the D-Mart chain of supermarkets.
D-Mart, I've heard of them. They're known for their low prices, right?
Exactly. They've been rapidly expanding their footprint across India, and their focus on value seems to be resonating with consumers.
It's a smart pick, considering the report's emphasis on the growth of organized retail. Any other picks that you found particularly interesting?
Well, they've also included Bajaj Finance,
Okay.
a non-bank financial company that focuses on consumer lending.
This ties back to their bullishness on MBFCs, doesn't it?
Yeah.
What's their rationale for picking Bajaj Finance specifically?
Well, Bajaj Finance has a strong track record of growth and profitability.
Okay.
They're known for their innovative lending products and their focus on technology. The report seems to be impressed by their ability to adapt to the evolving needs of consumers.
It's fascinating how these picks really illustrate their investment strategy. What about some of their other picks outside of financials and consumer discretionary?
Well, in industrials, they've included Larsen and Toubro. Okay.
Which is one of the largest engineering and construction companies in India.
Larsen and Toubro, or L&T as they're often called. They're a giant in the infrastructure space, aren't they?
They're involved in a wide range of projects, from roads and bridges to power plants and factories. Morgan Stanley seems to be betting on their ability to capitalize on India's infrastructure boom.
And given the government's emphasis on infrastructure development, it's a logical choice. Did they include any tech companies on their list?
Yes, they've picked Infosys,
Okay.
which is a major player in the IT services industry.
Infosys is one of those Indian tech giants that's gone global, right?
Absolutely. They provide a wide range of IT services to clients around the world. Morgan Stanley seems to be betting on their continued growth as the demand for digital transformation services remains strong.
So their focus list really gives a snapshot of their investment strategy. It's a mix of established leaders and companies that are well positioned to benefit from the trends they've identified. I agree. The list reflects a balanced approach to investing in India with a mix of large cap and mid cap companies across various sectors.
Well, it's been fascinating to break down this Morgan Stanley report with you. It's given us a really comprehensive and insightful view of the Indian equity market.
It really has. India presents such a compelling investment opportunity.
Yeah,
But as with any market, there are risks and complexities to consider.
exactly. That's why it's so important to do your homework. Understand the macro trends, dig into the specifics of the companies you're considering, and of course, align your investment decisions with your own risk tolerance and financial goals.
I couldn't agree more.
Well, that wraps up our deep dive into the Indian equity market. Hopefully you feel a bit more informed about this dynamic and exciting market. We'll be back next week with another fascinating report curated just for you.